Hello everyone and welcome to our latest BKL webinar covering yesterday's 2024 budget. I'm Anthony Newgrosh, thank you very much for joining us, and I am delighted to be joined by my old friend and colleague Geraint Jones. Hi Geraint.
Hi there.
And for the first time from Wilson Wright, who is now proudly part of the BKL family, it's Neil Lancaster. Hi Neil, welcome aboard.
Thanks Tony, hi everyone.
Okay, so much to cover from yesterday. So we did do a little slide about us, but we're all old friends. So we'll skip through that one and crack on with what we'll be covering today. So we're going to focus on mainly the personal taxes and in particular the changes concerning residency and the non-dom tax regime. I guess not a huge surprise, a Labour policy that was taken by the Tories that the Labour is now implementing, but Geraint will cover that in some detail for us. Some significant IHT changes that we'll look at, and also, well, could have been worse, but some increases in CGT rates. We'll look at that, followed by a brief tour of the property taxes changes, and then just summing up at the end with any other business. So, with the sort of proverbial 10 o'clock news bongs, let's just have a quick look through the budget headlines. So a £40 billion tax budget yesterday. You could call it it could have been worse budget, but still very significant. I think the largest increase in our lifetimes, or certainly in this generation of taxes. Significant increases in employers' national insurance contributions, which makes up more than half of that 40 billion. And as we mentioned, IHT changes, including quite a controversial move, including pension pots within your lifetime estate and restrictions on business property and agricultural property relief. Headline rate of CGT, as we mentioned, goes up, and further bad news for landlords, additional stamp duty land tax to pay on second homes. And as we were all expecting, the abolition of the non-domicile status. I think if this was a weather forecast, it could be sort of summed up as a severe fiscal depression heading in from the east, leading to heavy and persistent taxation over the next 5 years, particularly in business areas. But right, there was a lot that wasn't in the budget yesterday. Do you just want to summarise, I guess, what we regard as largely good news?
Absolutely. Using your theme there, Tony, it could have been a lot worse. All of these were mooted as possibilities. I'll quickly run through them. Employers' NIC on salary sacrifice going to pension pots. I think that was always going to be quite difficult for final salary pensions. So I can't see that being implemented anytime soon. The removal or partial exemption of pension tax-free lump sums, i.e. reducing it down from about 268,000 to say 100,000. We probably dodged a bullet there, but I wouldn't be at all surprised if Rachel Reeves needs any more tax, she might come back and go for that one. No tax relief on pension contributions being restricted to the basic rate of tax. Once again, I suspect that's too difficult to implement with final salary pensions. Extension of the 7-year potentially exempt transfer tail. That could easily be one they come back with at a later point, or even completely re-examine inheritance tax. We'll have to wait and see on that. Abolition of the residence nil rate band. That's another one that could go. Once again, it only affects a relatively small percentage of the population, mainly in the south of England. So I could see Rachel coming back for another bite at that one. Fundamental changes to the principles of inheritance tax. I kind of mentioned that a little bit earlier. I think that's something that we may see later in this Parliament. Restriction on ISA pot limits. We've had a lot of talk around the place about millionaire ISA pot owners. So the government could very easily restrict pot limits to 500,000, say, and then just say that anything over and above that does not get an income tax or a CGT exemption. So once again, that's one that I can see coming back at a later point. Dividend tax rate. Those of you from a vintage to me will still vaguely remember investment income surcharges when there was a 15% surcharge on dividend income. So they could easily introduce a surcharge on dividend tax as well. Once again, maybe that's one for the future. We'll have to wait and see.
Okay, thanks, Geraint. But still, 40 billion, tax take up to 38.2% of GDP. I think that's more than I got in my home economics O level a few years ago, actually. So high levels of taxation. Neil, just as a sort of general question, did you think it was a bold budget? I mean, a lot of it in the end was just tinkering with rates rather than anything fundamental.
Yeah, I actually didn't think it was particularly bold, to be honest. I think the key reason there is that actually this was intended to be a growth budget, and indeed there will be, in theory, some growth generated from this budget, but most of that growth won't be generated from many of the fiscal policies that have been introduced. It will really be derived from a lot of the capital investment that they're raising from external investors to fund things like renewables projects, infrastructure projects, and that is a very short-term boost to the economy. And actually many of the fiscal provisions that we're talking about today actually, to my mind, have the impact of really disincentivizing enterprise, disincentivizing small, medium-sized businesses and entrepreneurs from starting businesses and growing businesses. So I actually found it quite a demoralizing budget rather than a bold one.
All right, well, hold that thought, we shall see. I guess there was always going to come a time when the generous support during the COVID period would need to be paid back. But okay, let's start our troll through the budget by having a look at personal taxes. We know Labour were quite firm about their guarantees. There'd be no increases in income tax, NIC and VAT. So not too much to talk about here, Neil, but do you just want to summarise it for us?
Yeah, I mean, look, it's absolutely no surprise at all that fiscal drag, which is this concept of people being brought into tax or being brought into higher rates of tax through keeping personal allowances and personal capital gains tax exemptions and inheritance tax exemptions stationary. Over time, this creates billions of revenue. We fully expect that they will continue to freeze allowances. Potentially some rays of light at the end of the tunnel. We're told that for income tax from 2028, our personal allowances for income tax will increase with inflation, and I think it was 2030 for the inheritance tax nil rate ban, which of course has been frozen since the early noughties, and this is why we've seen very recently so significant amounts of inheritance tax being taken relative to even 5 or 10 years ago on a monthly basis. So it's a bit of light at the end of the tunnel there, but it's of no consolation to those who feel poorer every month but don't quite understand why.
Well, yes, and people, although there have been no changes in employees' taxes, of course, in the world's least best kept secret, there was very significant changes to employers' NICs, Neil, wasn't it?
Yeah, absolutely. And just on this slide, we anticipated that we would be looking at an NIC rate increase. We just weren't quite sure exactly which tack they would take. As it happens, they've gone with a straight line 1.2% increase on employers' NI contributions, so rate now 15% from 13.8, and obviously that's a hard cost to business. There's some tinkering with the rates at which businesses start to pay NIC, with rates being increased from 5 to 10,500, but really that's just going to help the really smallest of businesses and not necessarily the majority of our clients.
I think I saw that for an average employee, this is going to cost £1,000 per annum for employees, and I had one client yesterday, he'd already worked out this was going to cost him £70,000. Ultimately, it's got to, it's going to hit businesses, and it's, as Rachel Reeves I think acknowledged this morning, this may mean that pay rises are reduced. So yeah, employees are ultimately going to pay the price.
Exactly, and this is obviously one of the promises that was made to taxpayers by the Labour Party was that they wouldn't increase taxes on working families, and although they haven't increased the headline rates of tax on employees, they have for employers here. If you've got two individual families and the tax burden is going up by £900 to £1,000 a year, then
one issue we've always looked at for where you've got your own personal company is how you should remunerate yourself. Should you take dividends? Should you take salaries? Very different sort of tax answers, as it were, but ultimately, I guess, how much money do you get in your bottom pocket is what people are interested in. Historically, it was always dividends was generally taken to be the cheaper route. As dividend tax rates have been increased of late, that's been whittled down. I think it's changed again, hasn't it, Neil? And I know we've done a couple of calculations, which I don't think we're going to talk through in detail, but I think these next two slides just illustrate the point that it very much needs to be looked at on a case-by-case basis. But do you want to just give us a heads up here?
Yeah, I mean, as you said, Tony, historically, usually just taking a small salary and a dividend was going to be the optimal rate or the optimal approach. The question was just how optimal is it relative to just taking a straight salary. In general, that's probably going to continue to be the case, but there are some nuances where you pay larger sums, and where you're in the sort of 45% tax band as well. So as we're when you're starting to look at scenarios in those sorts of categories, then we do need to look at it in a bit of a closer detail, and there's no one size fits all.
Yeah, I mean, I'd say a couple of examples here. We've got a company with £150,000 of profits, and the individual wants to take out £100,000 gross. Per our calculations here, he's better off taking a dividend. But the situation does change in this situation. You'll see salary looks like the better route here, where you've got a company with much higher profits of £1 million, and the individual wants to take more out. So we do need to look at this case-by-case basis, and don't forget issues like, for example, if you can claim R&D tax relief on the salary, that may also skew the equation. But I don't think it's a simple question, and not one we can give a simple answer to in all cases anymore. But we are, of course, very happy to assist any of our clients who might want to revisit that. Okay, Geraint, I think strap yourself in. We're going to look in more detail now at the changes to residency and non-domicile tax regime. This, I guess, is nothing new, Geraint, is it? We were largely expecting this, and it was trailed by the previous Conservative government. I think the intention is we will do a more detailed webinar on this in due course. But Geraint, if you'd be kind enough to talk us through the headlines, as it were, and then, as I say, hopefully we can drill down in due course into more detail.
Okay, no problem at all. As you'll all be aware, this was quite heavily publicised for quite a long while now. So I suppose the most surprising thing about this is that there was nothing surprising in it. Most of the projected and proposed rules have been taken on board with very little adjustment and very little amendment. So most of this should be familiar to you guys out there. But running through it quickly, for the first 4 years of residence, there will be 100% tax relief on what is called FIG. So that's foreign income and foreign gains. So that means those monies can be brought into the UK completely free of tax charge. There's no remittance, no domicile, no nothing. The only qualifying criteria appears to be that you must have not been UK tax resident in any of the 10 years immediately prior to arrival. So that gives the opportunity for British expats who've been working abroad for more than 10 years to now come back to the UK and get a complete exemption on foreign income and foreign gains. Which sounds quite appealing, really. You can build up your investment portfolios whilst working in another country and then come back to the UK and liquidate everything and pay absolutely no tax. So for the first 4 years, that looks quite attractive. Returners, as we call them, are clearly one of the main beneficiaries from the changes in the non-dom rules. Claims, it looks as though they're going to be done via a tax return. Release not going to apply automatically, so it's not going to be a default position. So make sure you fill out your tax return. you'll be able to apply the FIG relief to either income or gains or both. Or you can even do it on a source by source basis. It's going to be completely up to you. As with most things in life, there's a price to be paid for things, and the price to be paid for claiming the FIG regime will be the loss of your personal allowance and your annual capital gains tax allowance. Well, if your income was more than 125,000, you'd lost your personal allowance anyway. So the loss of a £3,000 CGT allowance doesn't appear to be much of a loss. So it seems to be pretty much a no-brainer that one would strongly consider going into this regime. The idea is that there'll be no further tax charge when any foreign income or gains to which the relief applies is remitted to the UK. Former remittance basis users will still pay tax on pre-6 April FIGs though. So this isn't going to be grandfathered in any way. So if you've got remittance protected monies, they won't qualify for the FIG regime. However, for the first 4 years of residence, you will get this. And if you've only been in the UK for 2 years, so far we understand that you'll have a further 2 years to make up your 4 years. So people who only came here recently will still have be able to benefit from this. It looks as though not all income and gains are covered. Most are, but not all. And we've listed some exceptions there. Certain foreign pensions, offshore life assurance policies and investment bonds, and income from overseas activities. I think this is the chargeable overseas earnings regime, which I think is going to go completely. So you wouldn't be able to shelter overseas earnings on the grounds you're only doing incidental duties in the UK. That will no longer be possible to be sheltered from UK tax.
Okay, thanks, Graham.
Right, going on to slightly more esoteric stuff, I'll kind of rattle through this reasonably quickly because this is worthy of a webinar in itself. The FIG regime will apply to the settler interested trusts. So if you recall, the protected trust regime allowed foreign income to be exempt from UK tax, known as protected foreign source income. Well, the FIG regime will apply to that, but after 4 years, it'll no longer apply. Pre-April 25 FIGs will remain protected unless they're distributed or benefits made available to UK beneficiaries. So as long as you keep them in the trust or distribute them to non-UK residents, then you're still okay. From the 6th of April 25, therefore, as a result, all income arising under a settlement will be taxed on the settler as it arises if the settler or their spouse or civil partner has retained an interest, or the income is provided to apply to the benefit of the settler's children, or the capital sum conditions are met. We'll probably talk about those in rather more detail when we do a bespoke webinar on this. The benefits charge will only apply to UK resident settlers who receive benefits after April 2025 if they are matched to pre-April 25, a protected foreign source income. From April 25, gains attributed to settlers are no longer treated as the highest part of their gains. So that's an interesting minor concession. Individuals will be able to allocate their basic rate band available in whichever is the most beneficial way that they choose. So it's a small stop. And there's also a small stop saying that there's no longer any restriction on setting personal losses against attributed gains. So that's another small minor thing. It'll help to simplify matters, but I doubt it'll have a significant financial effect on most people.
Okay, and Graham, what about CGT rebasing?
Right. This is another important issue that people will need to be aware of. So there'll be a rebasing available to people who have previously claimed the remittance basis or are currently claiming it. They will be able to rebase their personally held, and note personally, foreign assets to market value as at 5 April 2017. And there are various conditions to this. The first and most important one is that they must not have become UK domiciled or deemed domiciled before 6 April 2025. They must have claimed the remittance basis at least once between 2017-18 and 2024-25. They must have held assets on the 5th of April 2017, so this doesn't really apply to post-April 17 purchases. And the assets must have been situated outside the UK from 6 April 2024 to 5 April 2025.
What's the significance, Brian, of the 5 April 2017 date?
I mean, that was a significant date for UK non-domiciled tax regime. That was the I'm trying to remember the precise relevance of that date. Neil, can you dive in here?
Yeah, well, it was also it was when we last saw the last significant change of the non-domiciled legislation, where we saw the reduction from to 15 years for the overall non-dom regime. In reality, I think the real reason that 2017 is used and not earlier is it's the furthest back you can go, whereby people are required to keep records of their tax affairs. So it's usually 7 years. So that's probably why they've taken that date as well.
Thank you.
All
right, Geraint. Overseas workday relief.
Right. HMR, well, the government did say that they were going to retain overseas workdays relief, but changed it slightly. And what they've done is they have extended it from 3 years to 4 years. They've restricted the financial limit, so to claims of the lower of 300,000 per tax year or 30% of qualifying employment income. One of the benefits with this is that you'll no longer need to keep your account overseas. So they'll be no longer setting up brand new tax accounts abroad to be salaried abroad. It'll just apply automatically to the number of days that you're working abroad in a year. So if there's 220 working days in the year and you worked abroad for roughly, say, 22 of them, then 1/10 of your income will be exempt from UK tax. That kind of goes into the FIG regime as well. So,
okay. Shall we then talk about the temporary repatriation facility, Geraint?
Absolutely. This is really quite complicated in places. So I'll try and do this as lightly as possible. The idea is that HMRC or the government want to have a period of 3 years during which previously remittance protected monies can be remitted to the UK with a bargain tax rate. And the bargain tax rate is going to apply from 6 April 2025 through until 5 April 2027 at 12%, and from 6 April 2027 to 5 April 2028 at 15%. So the idea is that you will be able to bring in any monies from abroad in these fixed in these mixed accounts that have previously been remittance protected, that you can bring them in at these bargain rates of tax. Now, there'll be no foreign tax credits available against these. This money will be deemed to be net of a foreign tax credit. You'll get no credit at all. So if you've already picked up, say, a 15% dividend withholding tax on the monies, then you'll be paying a further 12% on the net amount that you're then bringing in. It's still probably attractive to look at. It seems that mixed accounts abroad with loads of stuff that's just been muddled up, you can just do a blanket election for the whole lot to be brought into the UK using this this rate. There's a concept called designation being introduced where you will designate any amount or any source as being available for this new regime. So once again, for those people who've got very muddled up overseas mixed accounts, this could be quite an attractive option. And you don't need to bring the money in the year in which you designate it as well. You can bring it in a later year. Once again, there's a few conditions. You must be a former remittance basis user, which is probably self-evident. The benefit distribution must be received during the temporary repatriation facility period and must be capable of matching the benefits and distributions to FIG that arose within the structure before 6 April 2025. The way it interacts with business investment relief is very complicated, and we'll probably leave that to another day. We can designate FIG. Sorry, can't.
No, it's too fast. Sorry.
They can designate FIG that has been used to make qualifying business investment reliefs as well. But as I said, and Tony was a bit ahead of me there, we will talk about that on another day, I think.
Okay. Anything to add on offshore structures, Grant?
Just a little bit here. You can designate pre-April 15 unattributed FIG held within offshore trusts and companies to the extent that they are matched with benefits that are received during the 3-year temporary repatriation facility period. So that's quite attractive. It's not available to income distributions from offshore trusts or other offshore entities after 5 April 2025. And benefits or capital payments received from 6 April 25 can be a qualifying overseas capital. So it can be designated under the TOF, but again, only if matched to pre-April FIG. Okay. So lots of stuff there to be worth looking at.
Okay, Neil's going to talk about the IHT changes announced yesterday, but I think there's just a few points you wanted to highlight relevant to the changes to the non-dom regime as well, Geraint.
Yes, yeah, absolutely. So there's a new residence-based regime being introduced for inheritance tax from 6 April 2025. And that basically says that if you've been resident in the UK for 10 or more years out of the last 20, then you will be liable to UK inheritance tax. So rather more strict than previous years. Individuals will remain within the scope for inheritance tax for a period after they leave UK residence. This is going to be between 3 and 9 years. So you will continue to be a court from until between year 13 and year 19. The idea is that people who stay for between 10 and 13 years remain in scope for 3 years, and then you add another year for each year from that. So 15 years of residence would give you 5 years in scope. So that would make it 15 years. And then 17 years if you spent 7 years after the 10 years. So it goes on to that and it tops out after 19 years. So the maximum you can still be caught will be 19 years.
That's quite a tail, though, isn't it?
It is still quite a tail. So you can reset the position as well. If you leave for 10 years, you get another 10-year clock starting. But it's still quite harsh, and I think we'll see a lot of people exiting after 9 years to prevent picking up a 10-year plus tail.
Okay. All right. Thanks, Grant. Before we let you have a little lie down, changes in respect of trusts that are relevant here.
Yes. Excluded property status of non-UK settled trusts will depend on the settlor's residence now, rather than their domiciled. They'll only be excluded property at times the settler is not a long-term resident. So people who are long-term residents and have settled offshore trusts, the assets will be subject to the inheritance tax regime. So there's not much solace there for people who set up excluded property trusts. So once again, the message seems to be, think very carefully if you want to stay here for more than 9 years. On relevant property settlements, trusts with a non-domiciled settler as a long-term resident, exclusive property will become relevant property on the 6th April 2025, and therefore inheritance tax charges will apply on exits from that date and on future 10-year anniversaries. So once again, people need to consider whether they want the settler to still remain in the UK after 9 years, or whether the trust should be broken open before the relevant property regime kicks in.
All right.
So it's difficult. Significant changes, and a lot of advice needs to be given there.
Okay. Well, that's why we've got you and Neil here. So, okay, Geraint, thank you for that. Let's now turn our attention more specifically to the IHT announcements that were made yesterday. I think it'd be fair to say, Neil, these were a surprise. And if there's one area that I think is going to hit clients potentially the hardest, it may well be these changes. So why don't you give us the bad news, as it were?
Yeah, this is definitely the one area which I think is going to cause some real problems. It's not just going to cause problems for families and their businesses, but there are huge business continuity issues nationally which potentially need to be considered as well. And I think this is the one area, yes, we weren't necessarily expecting. We were expecting that at some point HMRC would look at business property relief, for example, which applies mostly to shares in trading businesses, and agricultural property relief to farmland and tenancies and farming businesses at some point. But having these policies implemented yesterday was a little bit of a surprise. And I, for what it's worth, I do think there's going to be a huge amount of pushback to these. Because of the fiscal policies, these have the potential to cause some real problems economically as well. So I wouldn't be surprised to see some of these policies changed in the coming months. But for now, we have to assume they are going to be implemented. So I'll just run you through these changes. They are expected to, from April 26, raise about 2 billion a year in terms of inheritance tax. So small fry relative to national insurance, raising 25 billion. The non-dom regime over 5 years expected to raise 12.7 billion. So let's just run through these. So I mentioned earlier freezing of the inheritance tax nil rate ban, staying at 325,000. It's been that since the beginning of my career 21 years ago. So it's continuing to drag estates into inheritance tax, particularly those with significant gains on real estate. There's also this additional £175,000 residence nil rate band, where you're passing down a main residence as part of your estate to beneficiaries, and equally the value of the estate at which that additional £175,000 gets tapered down has been frozen at 2 million as well. But as I said, we expect to finally, after all these years, see someone tapering at 2030, but I'm not going to hold my breath at this point. So the real interesting thing yesterday was the change to business property relief and business agricultural relief, property relief. First of all, and any individual will have a lifetime limit of 1 million for business property and agricultural property, which will continue to receive a 0% effective tax rate. So 100% relief will continue to apply to the first million of such property. But above that, where you have got qualifying assets, a 50% relief will apply, which mathematically gives you an effective rate of 20% inheritance tax on those assets. Equally, AIM shares will no longer get the 100% business property relief after you've held them for 2 years. That will now fall to 50%. The problem with these provisions, really, from a policy perspective, lies in the fact that they're viewed as a tax loophole or a get out for the wealthy from their estate returns, and on paper they effectively are, actually. But the problem is that the rationale for these policies originally wasn't to allow wealthy individuals to exempt their estates from business property or farms. It was really to ensure business continuity within the economy. Clearly, if you have a £10 million business and you have to pay 4 million of inheritance tax on that, then you may not have the liquidity in the business or within your estate to pay that tax, which may mean having to sell the business, sell assets, refinance, which can obviously cause problems with those businesses in the case of farms, food supply, etc. as well. So I don't think these provisions have necessarily been thought through that extensively, and I do think there's going to be wider consultation on these, and rightly so. But this is an area that clients are going to have to think really, really carefully about going forward. It's going to lead to very, very significant extra exposures in individuals' estates. So many people have life cover to cover the parts of the estate that aren't covered by any reliefs, like business property relief, and in those cases they're going to have to think about whether they need to extend that cover, if only just to ensure there's liquidity to pay tax and that the business can continue unabated. The other thing, not so surprisingly, that we saw yesterday was the introduction of inheritance tax on pension pots. The reason I say not unsurprisingly is that it is the logical next step, given that the Conservatives uncapped the lifetime allowance in their budget a couple of budgets ago. And so we've been expecting that pension pots would come under the scope of inheritance tax at some point. And that point will be 6th of April 27. It's expected that in most cases, the pension funds themselves will be responsible for reporting the inheritance tax and actually paying the tax. But there will be a consultation, because clearly, if you've got SIPs or SASs that contain commercial real estate, there may be good reasons as to why you wouldn't want the pension to pay the tax, and equally there may not be the liquidity. So the finer details of this will become apparent post the consultation, and will no doubt feed into that, as well as pension providers. APR, similarly to business property relief, as I just mentioned, will fall to 50%, and will also cover land managed under environmental agreements with UK government bodies and agencies. And the last point has already been covered by Geraint in respect of excluded property trusts, which I know in the not too distant future will be probably looking to do a webinar specifically around not only what does this mean for trusts, which Geraint's just covered in some detail today, but also what does life post April 25 look like for settlors and families with structures that currently fall within excluded property regime.
Okay, thanks, Neil. So I think based on what you said, we can expect strong pushback on these changes. So watch this space. But this does significantly change the landscape, doesn't it? I get the point about AIM shares perhaps have been seen as a somewhat artificial way of avoiding IHT in the past, albeit it did provide a significant boost to AIM businesses, didn't it, in attracting investment. But we'll see. We'll also see the technical analysis on the changes in respect of pension pots. Of course, as soon as we know more, or if matters change, then we will let you all have further details. So that's the inheritance tax, both yesterday's news and what Geraint had covered leading on from the abolition of the non-dom regime. Let's move on now to capital gains tax. Time marches on. This is an area that I think we're all fearing the worst, but well, go on, Neil, tell us what actually happened yesterday.
Yeah, so look, this is, CGT changes. They're expected to raise about 2.2 billion a year. So again, relative to the total tax take in yesterday's budget, relatively small. But this was one area where, it was the area really outside of the non-dom regime that most of my clients were really bothered about. Very, very, many of my clients very, very concerned, and to some extent, in some respects, breathed a bit of a sigh of relief yesterday, but still there were some quite extensive changes. So we saw the basic rate of capital gains tax increase from 10% to 18%, but more importantly for most of our clients, the headline rate of or the main rate of capital gains tax increased from 20% to 24% from midnight last night. So only a 4% increase. I have to admit, I expected it to be close to 28-30. I think what they've done is they tried to keep a slightly lower headline rate by effectively skewing the entrepreneurs' reliefs rates, which I'll come on to in a moment, to get the overall numbers to work. But as of today, for most assets, with the exception of residential property, 24% will be the main rate. Business asset disposal relief, or what I still call entrepreneurs relief, saw some changes yesterday as well. The big relief was that we still have business asset disposal relief. There was some talk about this being abolished. It remains a 1 million lifetime limit. I do think the bigger question in the longer term has to be, why is it only one and not a higher number as it was originally? It was originally 10 million, then 5 million, then 2, and then 1, but this does need to be looked at some point. But the flat rate of 10% on the first million of gains for business sales will increase from 10 to 14% from next April. And then from April 26, there'll be a rise to 18%. So fairly significant change there, but in the grand scheme of things, small businesses will still get the 1 million limit, and for more significant sales of businesses, this relief was only ever worth £100,000 of tax. So the impact, I think, is more psychological for most of my clients than numerical. The other one, which is the other big surprise yesterday, was the change to investors relief. This relief actually is very little known in the world. It's very rarely claimed, although I think it's often missed with clients. And broadly, investors relief applies where individuals subscribe for shares in businesses. They have to be new shares, so typically on capital raises or new startups. But whereas entrepreneurs relief applies where you're an employee of a business, investors relief applies broadly where you're a passive shareholder and at most an unpaid director. So typically this applies where you may hold shares in or subscribe for shares in businesses in overseas companies. And interestingly, the limit was still 10 million for this. I think the legislators missed this point when they brought down entrepreneurs relief years ago. So as of midnight last night, that limit has been reset to 1 million in line with entrepreneurs relief, and the same increases will apply to investors relief going forward. So 14% from next April and 18% from April 26.
Yeah, I think the key point just to highlight there is the changes to the BADR rates apply from 6 April next year, don't they, Neil? So
correct, absolutely.
There's still time on that one. There was also, not unexpected, a bit of sort of anti-avoidance, anti-forestalling rules here, just to flag up, Neil.
Yeah, so I know that particularly in private equity, there's been a lot of work going on around crystallising gains prior to 30th of October, just in case. Some clients may not be too bothered, given the rate was only 24% at the end of the day, given as opposed to 30 or 40 or 45 even. But there are anti-forestalling measures which will effectively mean that some of that planning or much of that planning won't effectively work. For the more nuanced structures where we've put new, where there may have been a new holding company put on top of an existing company. in order to try and trigger gains, that won't necessarily work either as a result of these provisions. So if you are in that boat, by all means have a chat with us.
Yeah, I don't think any huge surprises there.
No.
We were just briefly going to mention employee ownership trusts, which I guess becomes more and more relevant now given the increase in CGT rates. And I don't propose to talk through all of these points, but just to flag up the principle, this was a very attractive route that allowed business owners to effectively sell and cede control of their business to their employees by selling the company to an employee ownership trust. It wasn't quite the magic bullet for the employees that it might seem, given it's not so tax efficient going forward. But the key headline for the original owners is it did allow them to sell their shares completely free of CGT. So a 0% rate, clearly that is and remains very attractive. And there was some concern whether this relief would go. The good news is it's staying. There have been a few technical changes. I'll just mention just a couple of those. There was always this doubt as to how the EOT could be funded, because the EOT owes the original shareholders the consideration for the sale of the business. It could be, many millions. And typically that was funded by paying out, well, it was sort of dividends from the acquired company up to the EOT. But the problem was always, if it was a dividend, then potentially it was taxable in the hands of the trust. Well, there was always this concessionary treatment whereby it was held, it's sort of a dividend, but we'll treat it as non-taxable, and could you confirm HMRC? And we did have to go through a non-statutory process every time there. The good news is that treatment of distributions from the company up to the EOT has now been, or is being put on the statute book, so we have certainty that those payments to fund the consideration due to the vending shareholders remains. There are some additional information requirements, and as I say, a few other technical changes. In particular, the trustees of the qualifying EOT have to be UK resident at the time of the disposal. There can also be, the only other point I mentioned, a clawback of relief if there were disqualifying events within previously 2 years. For example, if the EOT sold the shares in the business, that window has now been extended to 4 years. So that's something we'll have to be very careful of going forward. But look, the headline is EOTs are still there. They're still very tax efficient, 0% rate, which compares, as we say, very favourably to the sort of best race case of 14% going forward. So that's EOTs, just sort of straddling between sort of income tax and the capital tax you talked about, Neil. Maybe just give us a quick tour through again, no huge surprises, the changes to carried interest that were largely expected.
Yeah, some change to carried interest has been expected. We still don't have all the detail even after yesterday, because there is going to be a consultation on this. But we just think about what carried interest is. Just first of all, it's almost like a priority profit share, which a fund manager or member of management in a private equity fund will get as a priority before shareholders are paid out above a hurdle. Now, the default as it stands at the moment is that all carried interest is income, is taxed to income, but there is a carve out for capital gains tax treatment where assets are held and satisfy for a certain period of time and qualify under certain conditions in the legislation. Now, the aim clearly of this legislation announced yesterday, not surprisingly, is to try and bring as much of this carry as possible into the income tax regime or the trading income tax regime going forward. What they are saying is that we're in the interim from April 25 to April 26, we're just going to increase the capital gains tax rate for those carried interests which do qualify for gains to 32%. It's currently 28%, so that's a 4% increase. And then going forwards, what will effectively happen is that carried interest will, as a default, again, all carry will be treated as trading income, but there will be a multiplier applied where certain conditions are met, which will probably broadly be along a similar vein to the current capital gains tax treatment conditions. If those apply, you'll get a 72.5% multiplier. So to put that into some numbers, if you have a carried interest payment of 100, you've held the assets in the fund for 10 years and you qualify for what would have been capital gains tax treatment under these new rules, you would only be taxed on 72.5. 72.5 at 45% income tax gets you to around about 32.5. So your overall rate won't be too different than it would have been under the capital gains tax rate from next April, 32. However, what this will also likely mean is that you'll also have national insurance to pay as well. So that's probably going to be another 2% on top. So in reality, a 4% increase becomes a 6 to 6.5% increase from April 26. And that's not been wholly appreciated in the last 24 hours by many.
Yeah, and indeed that multiplier can, of course, change in future years, Neil, can't it? Quite
yeah, and I think the reason they've gone with this crude multiplier is fundamentally for exactly that reason. They can move it up and down, both as an attraction to business in the UK, but also to raise taxes further. Obviously, there has been a bit of an exodus or a slow dripping out of private equity from the UK in recent years, and the fear, I think, is that if they had have just done 45% tax on carried interest from next year, that would have led to a mass exodus, whereas slowly increasing the rate with maybe hypothetically using this multiplier psychologically eases the tension a bit.
Okay. Just another couple of points I think you're going to cover there, Neil, on the employment-related securities exclusion.
Yeah, it's a very nuanced point, but the current rules provide for an exclusion of carried interest where you have an employment-related security, and what the government will have to do is legislate to remove that employment-related security exclusion, which fundamentally will ensure that income-based carry, which is the default in our legislation, applies fairly to all fund managers who receive carried interest and not just some of them. But more importantly, the detail of what this new regime will look like will derive from a consultation. We know that that's going to include slightly more stringent requirements. So, for example, I know that they're going to look at whether there should be a minimum co-investment requirement in order to get carried interest. So, in other words, requiring there to be real skin in the game, for want of a better expression, before any preferential treatment may apply on the multiplier we discussed before, together with a whole raft of other things. But I expect that most of the key conditions will relate to length of ownership.
Okay. All right. Thanks, Neil. I now get my 30 seconds of glory talking about corporate taxes, and not much to see here. Rates of corporation tax unchanged, and the roadmap that the government announced envisages that the 25% rate will stay for some time. Whether the small profits rate, I should say, strictly of 19% will remain is another matter. R&D reliefs have been largely left alone, just a couple of technical tweaks to ensure the legislation works as envisaged. No changes on capital allowances. And hardly worth mentioning, but there you go. Audiovisual and video games expenditure credits regimes, a couple of small changes there. One point that might be important, though, the government is consulting on abolishing I've said arguably generous, that's my humble opinion, the transfer pricing exemption for medium-sized businesses. These are businesses that have broadly more than 50 employees or turnover and gross assets more than 10 million euros. At the moment, as long as you are transacting broadly with an entity that's not sat in a tax haven, they can't touch you with transfer pricing. That doesn't mean they can't challenge you in other ways, but it is quite a generous exemption and certainly very favourable compared to other transfer pricing regimes. They are going to consult on whether that should remain, albeit we expect the exemption for small businesses to be retained. There's also consultations on land remediation relief, permanent establishment definition, and the diverted profits tax. So watch this space. The only other change that we saw yesterday was concerning so-called Section 455 tax. That's this upfront tax charge at 33.75% now, where a company broadly makes a loan to a shareholder. We had some anti-avoidance a few years ago to stop sort of bed and breakfasting, where the loan was repaid and then the money advanced again, to try and say, well, we're not in the regime, we have repaid within 9 months. HMRC lost a case on this a little while ago concerning one company repaying and another company in the group advancing the funds. The courts held that you're okay there. Well, HMRC have taken their ball away and tightened up with a much broader general anti-avoidance rule on this that broadly says if we don't like it, it's not going to work. So I can't imagine that's going to catch too many people, but there we go. And that's really it on corporate taxes. Not too much on property taxes either, but I'm afraid none of it really good news of what there was. We've already got a 3% surcharge on SDLT for the purchase of second homes and acquisitions by so-called non-natural persons, companies, trusts, etc. That was 3%. It's now 5% with immediate effect. And similarly, we had this sort of ATED related SDLT rate of 15%. That's, for example, where a company buys a property and the property is not being used for the purposes of a qualifying rental business or property dealing or trading business. You do that, previously 15%, but we've also been whacked with another 2% there. Don't forget, we've also got the surcharge for non-residents. So not welcome, a further hit to landlords, but what can you do? And there are, of course, some transitional rules if you'd exchanged pre-budget but not completed afterwards. I guess the one sigh of relief, we had the abolition of MDR, multiple dwellings relief previously. The other way you could potentially save SDLT if you're buying a block of residential properties. If you're buying 6 or more together, then you could choose to tax them to SDLT under the more generous rates for non-residential property. That remains. So, okay, some good news there. We had the confirmation that furnished holiday lets regime is to go from next April, and there is an increase in the ATED charges. Again, that's where you've got a property wrapped in a company that's not used for a qualifying business. Those charges will increase by, well, you might say a relatively benign 1.7% from next April. The other thing we were worried about that didn't happen was the possibility of NIC on rental income. Well, no news is good news there, so we'll take that one. There was also some tinkering with business rates. Well, not much to say here. There's a consultation and a bit of tinkering at the edges to try and help the high street in the meantime. So again, watch this space. The idea is to make business rates fairer and to encourage investment. We shall see, but that's all we'll say on business rates. And as we know more, we will let you know. So nearly there. Neil, just a couple of other changes as we head into any other business on VCTs, etc. Do you just want to talk us through this?
Yeah, no surprises on the whole EIS and VCTs. They were due, the EIS regime and the venture capital trust regime were due to expire on April 25. This has been extended to April 35 from memory. No, with that had already broadly been confirmed, but was reiterated in the budget yesterday. There's a couple of minor changes. The higher benefit income charge, it's administration really. The scrapping reform to base the higher income benefit charge on household income as opposed to individuals' income, and the government will allow employed individuals to pay the higher income benefit charge through the tax code from April 25, which wasn't previously permissible. The budget yesterday had quite a large provision. From memory, it was about 6.8 billion, which was really looking at anti-avoidance, but within that, it was penalising individuals with late paid tax bills with an additional 1.5%. An additional 1.5% interest rate additional to the current, I think it's 7.75% at the moment. So presumably the rate going forward will be 9.25% going forward. So quite significantly above the base rate, and that will take effect from April 25.
Yeah, and indeed, as you've alluded to or made the point, Neil, with interest rates generally heading northwards, that is quite significant. A few years ago, we almost didn't worry too much about interest and overdue tax, but that's certainly not the case now and won't be from next April. You did, though, mention anti-avoidance, and there was a fair chunk of additional legislation announced yesterday concerning this. Look, the bottom line here is HMRC are going after promoters of tax avoidance schemes. We've not got a great deal of sympathy with such individuals anyhow, so we shall see. But HMRC are looking at new powers to clamp down on that, and also advisors who they see as facilitating non-compliance. So the concern is obviously that is a little bit subjective, but we shall see. More generally, with HMRC getting 5,000 new compliance officers, additional debt recovery individuals, and I think we can expect to see sort of more nudge letters, etc., from HMRC. A little worrying is a consultation on HMRC's right to acquire and use third-party data. So Big Brother is coming after you. And listen, I guess we want HMRC to be more efficient. We want them to go after the bad boys. As we hear more, we will, of course, let you know. The other one we've mentioned there is umbrella companies, where there will be further provisions to ensure PAYE is correctly accounted for. So that's all to say on anti-avoidance. VAT, very little. Listen, we've all heard it. We all know about it. VAT to be introduced on private school fees from 1 January. Likewise, some anti-forestalling, where people are trying to prepay in advance, and similarly private schools are to lose their business rates relief from April 2025. But yes, I guess we all knew that. So that was the budget. Copies of these slides will be sent to you all, so thank you all very much for joining us, together with a link to this presentation. Should you choose to listen to it again, or feel free to share, it's also on our website and on YouTube. Thank you to those who sent in questions. I'm sorry we've not had a chance to answer those directly. I'll try and ensure I keep copies of those and see if we can come back to them. But otherwise, if you've any questions, do feel free to speak to your BKL advisor. Thank you to Geraint and Neil for joining me. Thank you to the team sat in the background there who've been beavering away overnight to ensure we could pull all of this together in 24 hours. And we look forward to you all joining us again soon for our next BKL webinar. We'll be in touch. So thanks all. Bye-bye.
Bye.
Bye.